Hello, everyone. Happy Friday. It's February 10th. Today, we will wrap the week focusing on how the markets have evolved. Yesterday's distribution sort of stabilizing today, but energy up big as oil prices pop to the upside. Ladies and gentlemen, this is the final bar. Hey, everyone. Welcome to the Final Bar. I'm your host, Dave Keller. I'm the Chief Market Strategist here at StockCharts.com in a sunny Redmond, Washington. Thanks for joining us every weekday after the close as we break down the activity in the markets using the best practices of technical analysis. The technical toolkit is designed to help you improve your market awareness by thinking a little bit more about market dynamics. Buys and sells, fear and greed, uptrends, downtrends, all net out into price behavior. And by analyzing price, we can gather information and try to make some inferences or some assumptions about what's causing those movements and what may come next. Today, we're going to talk about some of the choppiness that we saw in the markets today, but also how this week as a whole played out. So let's get right to our Wrap the Week segment. We're going to start with a poll, actually. We always have a poll going on our live stream page at StockCharts.com, also on our social media accounts. So make sure you follow us on Twitter at FinalBarSCTV. And on our YouTube channel, we asked you, in your opinion, what's the probability of the SPX closing above 5,000 on the last trading day of 2023? So this is looking down the road to the end of this calendar year, thinking about what the probability is. Over half of you, 54%, said less than 30%. 22% of you said between 30 and 50. The remaining 25% said there is a better than chance probability of it going closing the year above there. So if you think about those different buckets that I laid out, 76% of you said basically less than chance of a probability, right? Less than a 50% probability that we close above 5,000. This is an important question, and I think it's to get you thinking about what's the potential upside in these markets. If you're bullish, how bullish do you want to be, right? What's the real upside to be expected through the end of this calendar year? Most of us, including me, think it's highly unlikely that we close above 5,000. So think about that potential upside and then think about the potential downside to really best to understand the risk reward happening in the markets right now. Let's continue on wrapping the week. What we'll do is a couple different pieces. We'll start with looking at what the markets did today. Then we're going to look over at what I call the Wrap the Week chart, looking at the last 5 trading days. We'll finish off looking at some individual names and themes that I think tell the story of what happened through the course of this week. Today, on Friday, the S&P finishing the week at 4090. What's noticeable is that is below the 4100 level. That 4100 level was that breakout level, right? That was the peak that we eclipsed, right? Getting above there was so important. That was breaking above the swing highs from the fourth quarter of last year. Question is, can we hold 4,100? We didn't hold it as of yesterday's close. And today, even though we rallied a bit in the afternoon, not enough to get back above there. Today, honestly, was a pretty choppy day. Real net unchanged overall for most things. S&P up about 2.2%, that is. Mid caps and small caps all about the same. The Nasdaq composite, the Nasdaq 100, really the only major benchmarks on this page down for the day. Volatility came down as well, right? So the VIX is still above 20, so still what I would call elevated, but remaining above that 20 level. And, one of the things that I think is important to watch is if we see volatility creep back up. One of the real stories, I think, going into the new year here, so the last 6 weeks or so, has been the fact that volatility has not gotten too low. Now, all of a sudden, you're starting to get below 20. That happened over the last couple of weeks. And the question is, do we get back above there? Because that might mean a rotation lower in stocks. Look to see if the VIX continues to increase over the next couple of weeks. Interest rates, a key part of the story here. We had some inflation data that came out that was a little more inflationary than I think some investors wanted. This is pushing interest rates to the upside, it's putting growth stocks to the downside, which is related to higher rates. So the 10-year yield getting up to around 374, and that was really moving higher through the course of the day yesterday, just kind of picking up right where we left off yesterday and finishing strong. So bond prices going down through the spans of the day, and then the dollar index was up about 0.33%. That's using the UUP. Commodities overall pretty strong, right? The commodity index, the DBC, which is one of the commodity ETFs that we track, up about 1.4%. Gold and silver up, but not by much. Copper was really the only main commodity ETF that we track that was down on the day. So overall, energy certainly stronger, and that was another big story today. Was news from Russia about lessening supply. Essentially, is how I would summarize it. And that means energy prices start to go higher. So oil up, energy stocks up pretty big today, with a name like ExxonMobil making a new 52-week high today. Cryptocurrencies mixed as well. Bitcoin and Ether both in the red. The other 8 of the top 10 cryptos that we track on our platform, all in the green. Not a ton, though. This is sort of a low volatility day for the cryptocurrency space. Now, yesterday, a lot of them gave back a lot of ground. So yesterday, 2 days ago, right, we're doing this show and Bitcoin's around 23K. Now we're below 22,000. It appeared to be staying there for now. Might be an interesting chart to watch over the weekend. Let's look at what I call the wrap the week charts. What I like to do on a Friday, is really part of my weekly process, is to take a step back and just think about what has changed over the last 5 trading days. So if we start the clock at last Friday's close and look at what happened from last Friday to this Friday, you can see the S&P 500 down about 1% for the week. About half of the asset allocation ETFs and indexes we're tracking on this chart underperformed the S&P this week. In orange, we have the emerging markets ETF, which was down 1.7%. The Nasdaq 100 down 2.1%. In red, we have the TLT, which is a bond ETF, a treasury bond ETF, down 3.1%. In purple, that's small cap stocks down 3.4%. Now, leadership in small caps has been one of the interesting themes that we've been talking about here for quite some time. And arguably one of those risk-on measures has been the outperformance of small caps coming off of the October lows. This week, sort of the opposite of that. You see small caps underperforming as some of the growth areas of the market struggle, certainly going into the end of this week. Bitcoin, by the way, the worst performer, down 7.4% since last Friday. A couple things outperformed stocks. Gold was essentially flat for the week, which was a nice win over the S&P's down 1%. The dollar was up about 0.7%, and the big winner was crude oil prices here in brown, up 8.5%. So if you're long crude oil and short Bitcoin since last Friday, you had a really decent week. Not that that is a common trade or something I would necessarily recommend at any point, but it is worth noting the dispersion or the differentiation between the top performing things and the worst performing things, and recognizing that that spread often indicates opportunity. I want to go back and just continue this wrap the week segment, looking at a couple key charts here. On my dashboard, I've configured my dashboard. I'd encourage you to do this. If you click on the little gears, you can add what are called chart panels, and that gives you the ability to embed charts that you like watching right on your dashboard. By the way, I was talking with our developers this week. This is just the beginning of your ability to customize and make truly your own dashboard. That hopefully is coming later this year. It looks really cool, the test that we've been running on it. So I'll be excited to unveil that to you when it's ready. But for now, we do have the ability to incorporate some charts. On the left, this is my market trend model. This is the main model that I talk about with my market misbehavior premium members. As you can see, we remain bullish in the short term, bullish in the medium term, still bearish in the long term. It's getting closer and closer to that zero line. The main way I use these, they're all based on weekly exponential moving averages. If we're below the level, then that part of the model is bearish. If we go back above the zero line, it turns bullish. My long-term model has been bearish since May of last year. So about, 9 months ago. We're very, very close. And every week we've gotten closer and closer to that zero line. If we would generate a buy signal, meaning it gets above zero, the last 2 buy signals were in, we'll call it June of 2020. I think it was the end of May, beginning of June. And then before that was the first quarter of 2019, both after some pretty significant lows. We've not had that buy signal since the October low. We're very, very close to where we might get that. And I think that could be an interesting sign of potential further upside going forward, because the market would have to remain in a position of strength to justify that. Small part, the short-term part of the model almost went negative, but stayed just narrowly positive here going into the weekend. So at this point, remaining the same that it's been really through the course of this relatively new year of 2023, short-term bullish, medium-term bullish, long-term bearish. This is a chart that I call the chart, which I took out of my Mindful Investor Live chart list, which you can access on the StockCharts platform. I think one of the key stories we talked about so far in 2023 was the fact that the S&P has broken above one of the most obvious trend line draws, I think, in history, which is connecting the dots of the 2022 highs. You can see how we broke above that in January, I think, which is a pretty meaningful sign, really confirming this rotation from distribution to accumulation for the major assets. If you look, the advanced decline line here, still overall in an uptrend, although giving back some of the recent gains here this week and going into the weekend, it's starting to look a little more, I wouldn't know if a little more negative, but a little less positive. Now, both the S&P has not broken a trend line with the recent lows, neither have the advanced decline lines. If we would continue to go lower, that's sort of the thing that I would look for, right, on this chart, which I affectionately call the chart, right? Does the S&P remain above a trend line connecting the October and December lows? That'd be question one. Did the advanced decline lines also hold that level of support? That'd be question two. We're not there yet. Number three, do we remain above 50% of S&P members above their 50-day moving average? So far, we're holding that. First negative signal, I guess, sell signal on this chart would be the bullish percent index for the S&P 500. Going into the weekend, you can see it went back below the 70 level. And I think that could be a bit of a cause for concern here. Just to finish off our Wrap the Week segment, I want to show you a couple charts that I think are worth paying attention to on individual names. Number one, with earnings. We had a GPN Global Payments report before the open today. That stock had a decent quarter and a nice follow through to the upside. GPN now closing above its 200-day moving average. Now, the last time we were there, I'm ignoring this gap that we had a couple weeks ago. Last time we really got above the 200-day moving average was back in August and September of last year. Did not last very long, right? You can see we had a couple days of moving higher, and then we went right back below the 200-day. That's the risk for a chart like this getting above the 200 days. You pull an Alphabet or a Google, right, where you break above the 200-day and all of a sudden sellers just come in, or there's an exhaustion of buyers, the price goes right back down. So that would be the question mark. But for now, I like the strength going into the weekend on a nice earnings win. This has been a tough quarter for a lot of companies. Next comes another one, DXCM. This is a stock within the medical supplies group. Healthcare really has been mixed, but you're seeing some interesting pockets of opportunity. If you look at what happened with DXCM after the rally in the fourth quarter, traded below its 50-day moving average, which is not ideal, started to find support around 105, and that ended up being the floor in January, around 103 to 105. From there, we started to rotate a little bit higher. Look how the RSI bottomed out right at 40. Now we see the price moving higher after earnings. They reported after the close yesterday. Nice follow through to the upside, up almost 10% today. So the question would be, can it get above those highs from the fourth quarter? That means you want to see it get above 125. That would certainly indicate a potential continuance to the upside. What was not working today? Tesla and some of the other FANG and FANG-like names had a rough go of it here this week, but particularly today. Tesla has been a rock star chart coming off the lows in the first week of January. Today, down about 5%. Now, that's only this a little bit, right? I mean, we're up quite a bit from, almost 100. It's almost double off of the lows here. But a day like today starts to give you a little less confidence that we're in the midst of an uptrend and maybe that we're at the end of one. Look how the RSI was overbought and just as of today came out of that overbought region. That's the risk with something like Tesla that has had a good run. At some point, people are pretty happy taking profits if they bought earlier on in the uptrend. The question is, do we make a higher low? That's what I might look for on a chart like Tesla. Let's take a quick commercial break. We'll be back answering your questions from the Final Bar mailbag. We'll see you in a minute. Hey, everyone. Welcome back to the Final Bar. This is Dave Keller here at StockCharts.com. It is such a pleasure to do this show for you, and it's great to have you join us. We are super excited about our brand new studio. We're literally adding equipment through the course of this week and going forward. We will be there very, very soon with a lot of really cool plans for the show in the coming months. Couple quick announcements before we bring up the mailbag. Number one, the questions come from people like you. Send us an email with any questions that come up as you are analyzing the markets using technical analysis. Our email is thefinalbar@stockcharts.com. We're on Twitter @FinalBarSCTV, and we're on YouTube. Put a comment below the video you're watching on our Stock Charts YouTube channel. We'll hope to answer your question live in the air on Monday. Just to let you know about the upcoming schedule, we have 3 really good guests this week. I had a lot of fun talking with people like Jesse Felder and others. These are people with some really cool experience, good expertise in the markets. People like Ari Wald have a wide following in the institutional community, and it's great to just get some nuggets of what they're sharing with some of their institutional clients. Coming up next week on Tuesday the 14th, Miss Schneider of Market Gauge. On Wednesday the 15th, Greg Harmon representing the state of Ohio from Dragonfly Capital. And then on Thursday, February 16th, Sean McLaughlin joining us from Boulder, Colorado. He's the options strategist at All-Star Charts. Let us open up the final bar mailbag. And here is question one from you. With the SPY staging a strong rally since the October low and breaching key technical levels, what are the salient arguments in favor of the bear case? First off, magnificent use of the word salient. That was a good one. Those are sort of like the clear or obvious arguments, I guess is another way you might put that. So with the S&P rallying so beautifully off the lows, what's the bear case? I guess is what you're talking about. So you've probably picked up a number of my recent conversations have been pretty constructive, right? And I'm thinking of some of the discussions I have with like Ari Wald and others that, pretty constructive, right? Seeing strength in stocks, and the evidence of that would be strength of the markets off the lows, the fact that we've made higher lows, the fact that you're seeing offensive areas of the market really start to work, particularly growth areas of the market that have been struggling for so long. You're getting a risk-on feel from things like breadth indicators and so forth. So what would the opposite case? Thinking of some of the conversations that I've had, I would say one that comes to mind would be Katie Stockton, because we talked about the market finding support in the cloud, but also volatility and the risks of volatility increasing, right? If you think about the move that we've seen so far in 2023, really from the end of last year, you saw the market moving higher, and we start to see volatility come down, which is more of a bullish configuration. It wouldn't take much, right? So we just had one inflation reading today, and I think that was enough to make the markets mean revert very, very quickly, right? So there could be a situation going in the next couple of weeks, you start to see economic data that suggests inflation may not be done. Hints from the Fed that the finish line that we think feels very close is all of a sudden a little more distant. Would not take much for the market to roll lower. And I would be looking at the VIX to see it rolls higher. So that would be one part of the bearish argument. In terms of the evidence and what we see now, I think, one of the things that come to mind is just the fact that a lot of stocks have become overbought. Now, I would tell you that overbought means up a lot. By it on its own, the fact that something's overbought is not on its own negative, right? That should not be have a bearish connotation, but it does have implications for what we call mean reversion. What that means is even if it's still a bullish case, even if the S&P is going to get to 5,000 by year end, which I don't think it will, but it could. To get from here to there, it's not a straight line. And you sort of have these impulse moves and corrective moves. So one thing I would say is you've had the S&P that was just barely overbought in the last week. A lot of individual stocks like Tesla and others became overbought. Almost all of those are now no longer overbought because this week was a little more of a down week. So you're starting to see things that had those signs of being overextended start to rotate lower. Second thing I would say is look at my conversation yesterday with Jesse Felder. It's all about the dollar and about interest rates, right? Interest rates have come down quite a bit. The dollar has been weakening. Those two things have allowed the market to rotate higher, particularly risk assets. If you think the dollar has bottomed and bouncing higher, which it did today, if you think interest rates may be finding a floor and rotating higher, which they did through the course of this week, that's not a great sign for the equity markets, which have been flying higher because of lower rates and a weaker dollar. Finally, the thing, and then we have to move on to the next question. I was chatting with Jeff Hughes earlier this week. I haven't had him on my show since the end of last year, if I remember, but he had a pretty bearish wave count. And I was talking with him about the current market. He was saying basically this could be a big wave two. You have a big wave one down, a wave two, and then we're sort of bracing for a big wave three. Now, I'm not an Elliottian, but his comments about some of the proportions and what that means certainly sparked my attention. We'll have Jeff on the show and I'll ask him to show you real time what he's talking about. But those would be three things that come to mind, I think, that sort of are in favor of the bear case. Here's question number two. Though the trend appears to be changing, would you say there is still considerable overhead resistance all the way up to the all-time highs? And you went on to say, or is it risk on all the way as things stand today? So what I would definitely not say is it's risk on all the way. I think that's a dangerous comment to make. What I would say, and in my answer to the previous question, I was talking about how even if you're bullish, a healthy bull market has pullbacks, right? And just look back to 2021, right? It was a strong year for stocks, but it wasn't just a linear trend with a consistent percent gain every day, right? There were sort of these big moves higher and then these pullbacks. Now, the pullbacks were limited, maybe 3 to 5% at most, but there were pullbacks all along the way. So if you think about it, the S&P at 4,200 could pull back about what, 3 to 5%. That's not too bad, right? And you think about what the S&P could do still remain above the high from or the low from December. And what I mean is this, right? We topped out around 4,200. It's about a 9% drop to 3,800. We could drop about 9%, which would be another, let's say, 7% below current levels, still be technically within a Dow theory uptrend because we would be making a higher low. So there's room for the market to pull back within a longer term uptrend. That's when you have to look at some of the other supporting evidence like breadth, what types of names are leading or lagging, what's happening with gold and interest rates and the dollar and all these other things that I think are important. But I would say, so number one, no, I can't imagine it would be, a all the way risk on all the way to all-time highs. In terms of resistance, right, I think now 4,300, 4,325, the August peak, that's sort of the upside limitation to stocks. I mean, what would happen if we get much further beyond there? I think the configuration of this market would have to change quite a bit, and that interest rates would have to be moving lower. The dollar would have to continue to weaken to give room for the growth-oriented parts of the market, which are a big mega cap weight in our benchmarks, to be able to push the S&P and the Nasdaq higher. And I just don't see that happening right now. So yeah, I think there's considerable overhead resistance. What we've talked about off the October lows is the August 22 high around 4,300 as being sort of a natural upside limit to this market. We're not far below there. So that's what makes me skeptical about sort of the long and strong ride the risk trade higher in this environment. Let's get to the next question. In some of your charts, it says NYSE common stock only advanced decline line versus exclamation point AD line NYC. What are the differences there? And I think this is what you had a longer question. I think this is what you were trying to ask me with. And this is the chart that I believe you were referring to. And the short answer is there's absolutely nothing different with them. But let me explain. So on my charts, I tend to use a longer what you call the legend or the little the legends or a caption, right? So each panel has this little description. A lot of times people just leave it as the ticker, but when you're looking at breadth data, it's hard to remember what some of those tickers represent. I'm not a big fan of confusing acronyms to try to refer to things. I'd much rather understand exactly what I'm looking at. The way that you do that on a chart is down here below sharp charts, and you have the same setting within ACP. It's just off to the left where all your chart settings are. You'll see this little guy that says Legends, and I love the way, I don't know if this was Chip or one of the people that worked with Chip early on in StockCharts history, they used default, minimal, or verbose. I think that's such a great three settings there. If you set it to default, this might be what you're looking at. On some of the charts, this is sort of how it naturally comes up. And sometimes I just forget to change that to the verbose setting. I like to have the explanation what it is, but these are actually the tickers that I'm using to bring up these different series. So I like to set it like this because then it's just a little more clear which ones these are. And I don't remember the ticker for the mid-cap AD line necessarily. So this is just a little easier for me to refer to. Now, I will tell you, we have a lot of breadth data and a lot of different indexes from a lot of different sources. So if you're sharing charts with someone else, if someone's sending you things, if you see things on the air, a lot of times there could be some subtle differences. Make sure you look at the tickers that you're using because that will tell you a lot about the source of the data. Some of this breadth data, a lot of it, usually anything with an exclamation point is something that we are managing in-house here at StockCharts using the market data that we have available. Thanks so much for that question, by the way. Next question, can you explain this chart slowly, please? And I love that question so much, I had to feature it on the question. So I won't do the joke from Taxi, and I'm not that old. My parents used to watch Taxi, but if you go back, there's a famous episode where the guy's taking his driving test and has to talk slowly. I would encourage you to check that out on the YouTubes, but I will tell you what this chart is representing. This is a point and figure chart. The column of X's represent uptrends and the column of O's represents downtrends. This is a traditional methodology that was really created decades ago and was popularized by this gentleman, Abe Cohen, who had a firm called Chartcraft. I think it was in the 1960s when he wrote some books on this and had a research service built on point and figure charting. Our bullish percent indexes really come from Cohen's work, and others like Tom Dorsey and Jeremy Duplessis and others have really grown the use of point and figure, come up with some really cool ways. Ken Tower, who was at Schwab for a long time and now owns QAS, which is a quantitative service, did a really good job. I used to write questions on point and figure charting with Ken for the CMT exams many moons ago. What this tells you, right? The X's are uptrends. So every time we go up X%, and these are the settings you have down here. So you have a 1% box and a 3% reversal, which means every day you check the new high and see if we went up another 1%. And if so, you add a column of X's. If we go at least 3% down, meaning 3% in the other direction, you move to the next column. You're now in a downtrend because we've gone 3 boxes away from the previous trend. Now we're in a column of O's. So every day we track the new lows. Do we go another 1% lower? And if so, we add a no. If not, we check to see if we went 3% higher and we'd add a column of X's. And that's how we go from uptrend to downtrend. You'll also see these little letters and numbers. Those represent the first of every month, because one of the benefits of point and figure chart is it takes all the time off of the picture. This is just charting trends, not charting time, which is the normal x-axis for a bar chart. So 1 is January 1st, 2 is February 1st, and so forth. Just a quick visual way of understanding the trend. So the fact that we've had this big run higher and then this big move lower is what's called a high pull warning, which is basically we've gotten really extended. And now we had a bit of a sell signal. It's kind of a bearish sign, which is why you see the P&F pattern in red. Now, if everything I said was confusing or if it was not slow enough for you, and I apologize for that, we have limited time in the mailbag. Hit the magnifying glass, look in our chart school section on point and figure. We have some really good examples and explanations and tutorials to help make sense of it. At some point, I'll talk with Bruce Frazier and other point and figure analysts about doing a special to dig a little deeper in there, but that's the best I can do for now. We need to wrap the show. Let's go to the 3 in 3, 3 charts in 3 minutes that tell the story of this market environment. Here's chart number 1. We talked about interest rates a number of times this week. My conversation with Jesse Feller really focused on interest rates and the dollar, among other things, and how they related to leadership. This chart was one of my favorite charts to use over the course of 2021 because it showed how the leadership was so dependent on the interest rate environment. When rates were going higher, this is the 10-year yield that we have at the top, you can see that value is outperforming growth, which is what this ratio going higher represents. When interest rates would come in, you would see value underperform growth. In the second half of the year, really going into the beginning of January, you saw value consistently outperforming growth. And that's even in November and December when rates started to come in. We've seen rates continue to go lower. And so far, the 10-year yield has found support right at its 200-day moving average. This week, you're starting to potentially see a reversal higher in this ratio. But so far, year to date, it's been growth over value, and it has not even been close. Days like today, with energy at the top, with the FANG sectors at the bottom, feels a lot more like the leadership themes we saw in a lot of 2022. Makes me think that we might be in a period entering into higher rates as we break above trendline resistance after bouncing off the 200-day. And that would be most likely value outperforms growth once again. Chart number 2, kind of building on that theme, is one of the charts I have in my ratio list. Now, if you're a StockCharts member, you can download my entire morning coffee routine, which has a bunch of chart lists. And one of them is a list of ratios, which I think really help you compare and contrast different parts of different asset classes. I think it's a really interesting way of thinking about relationships and trends and reversals. When we look at the Qs versus the diamonds, we're basically doing another version of growth over value. When this ratio is going down, that tells you the Nasdaq is is underperforming the Dow. And you saw that was the case through much of 2022. When this ratio goes higher, it tells you the Nasdaq is outperforming the Dow, sort of growth over value. Look at how that hit its 200-day moving average, a declining 200-day, now starting to rotate higher. Now look at how this ratio lines up so well over the last couple of years with the overall market trend. The market tends to do well when the Nasdaq is leading because those mega cap names in those FANG sectors have a huge weight in our major benchmarks. If this ratio goes lower, look out below potentially for the S&P and maybe testing the 200-day once again. Finally, let's finish the week on a high note. ExxonMobil among a handful of stocks making a new 52-week high today. So as we talk about instability, uncertainty, inflation, interest rates, the dollar, et cetera, there are stocks that are working. And I think that's one of the great arguments for technical analysis, particularly using scans and alerts to let the platform that you're using tell you when something is a move or a breakout that you need to be aware of. I ran a scan at the end of the day of stocks making new 52-week highs, ExxonMobil right at the top of the list. So big energy starting to work yet again. Folks, that's a wrap for this week. I want to thank you so much for joining us all week. All of our great conversations and interviews can be found for free at StockChartsTV.com. For StockCharts.com in Redmond, Washington, I'm Dave Keller. Be well, be safe. We'll see you next week. guys, Dave Keller here with StockCharts.com. Thanks so much for watching our video. If you enjoyed it, and we hope you did, hit the like button right below. Also, we have so much new content every day. Consider subscribing to the channel. Just hit the subscribe button in the video or right below. Thanks for watching. Stay safe. Have a fantastic day.